Good morning and welcome back to Almus Market Mornings. President Trump just announced an exemption for USMCA goods from his 25% tariff, a relief for Canada and Mexico, though 62% of Canadian imports and nearly half of Mexican imports still face the levy. Markets, however, didn't cheer. Nasdaq slid 2.7% yesterday and Japan's Nikkei is down 2% this morning. All eyes are now on today's non-farm payroll data. JK, with these rapid fire updates, how do you think investors are gearing up for the NFP?
Good morning, Swaraj. Yes, despite the relief saw on the Mexican and Canadian tariff by the U.S. government, market continues to reel under a lot of uncertainty, not only on the trade war, because eventually either there has to be a good negotiation in favor of the U.S. or the tariffs will go ahead a month later. And more concern is about the U.S. economy as well, because yesterday's data also confirmed a lot of weakness, particularly on the employment side. While the weekly jobless claims came lower at 2,21,000 versus 2,35,000 expected. If you remember last week, it was at 2,42,000. But the continued claims was the one of the largest number that we have seen since 2021. And this continued claims is a number that includes people who have been out of jobs for some time and not able to find one easily. So that's one part of it. Another report called the Challenges Job Cuts report showed layoffs amounting rocketing to actually 1,72,000 in February, for the largest layoff since 2020. And if you remember, 2020 was affected by the COVID crisis. This tally was up from January's to 49,795. And last year it was at 84,000. Of course, the massive upturn in the government layoff was the primary reason, but the details show that a lot of retail and other companies are also laying off people. So that's a direct impact on the overall employment and also the consumption. Also, staying with some more bad news, US recorded the highest trade deficit of 131.4 billion in January 25, up from downwardly revised 98.1 in December 2024. And deficits widened with most of the major countries where the tariffs are under consideration, like China, EU, Mexico, and Canada. So of course this deficit, in some way or the other, US will have to address this. The tariff can be a double-edged sword. It can affect the countries which are being targeted. At the same time, it will also affect the US economy, which is already seeing signs of a slowdown. So higher inflation will tie the hands of Fed in cutting rates. Therefore, the economy will have to live with higher rates even as the economic activity is slowing down, which means eventually we will have a stagflationary kind of situation. So this is the background in which the Dow and Nasdaq actually fell more than 400 points. Nasdaq is now actually uh, you know 10 more than 10% below its peak, which means it is in a correction territory actually. So theoretically it can fall another 10% until it reaches a bearish territory. In the global side, we also had a ECB rate decision yesterday. They cut 0.25% to bring the deposit rate to 2.5%. Importantly, there is a lot of uncertainty and perhaps almost ruling out a cut in April 25. Not long ago, ECB rates were expected to drop up to 2% at least. But the situation in the last 1 week to 10 days has actually drastically changed, with the huge fiscal bazooka coming from Germany and more countries in the region also likely to spend. And this fiscal expansion is likely to result in monetary easing being stopped. While ECB did not say so in so many words, it does appear that the situation situation has completely changed, and the wording of the ECB president actually indicated that there will be some uncertainty going forward. Not clear. She did not say the monetary policy was less restrictive. Rather, it was more restrictive. She actually mentioned that it has become less restrictive. That means it can see a pause in April, almost definite, and going forward, it depends on how the economy performs and also the inflationary trend emerges as well. So all this, keeping the euro also well bid still. There has been fresh issuances of bunds by the German central bank, and then other central banks in the region are also planning more issuances. Europe will float a common bond also, which is meant to support the defense spending by various countries, and all this will keep the bond yields higher and keep the euro attractive relative to the USD. So we are seeing a situation where in Europe yields are going up, and in US the yields are, hovering in the lower range, and perhaps the US Fed is going to cut more than what we were expecting some time back. So all in all, euro is having a very good support. Technically, we have seen a breakout, which is drawing in more and more buying tips, and if there is no major surprise from US data indicating that US economy is still doing very good. I think test of 1.10 psychological level on the euro dollar is very likely. We also saw the Japanese yen strengthen beyond 148 yesterday. That was also again based on the softening US economy and the soaring Japanese yields. So the situation is that we are seeing narrowing of differential between US and other major countries, leading to US dollar weakening against these currencies as well. On the Indian front, we had the dollar dip to 86.90. In fact, opened at 86.90, but never went below that level during the day. In fact, soared to 87.15. The reason was that the previous day, RBI had announced a fresh buy-sell swap of US dollar 10 billion for 3-year tenor, and that, based on the previous auction in which the premiums had been cut off at a lower rate than the market price, market started to see lower premium once again. In fact, the 1-year tenor saw 0.2% decrease, for dropping from 190 to 173 overnight, opening with a gap. And suddenly, the importers and ECB holders found, to their pleasant surprise, spot lower as well as the premiums lower. So the huge buying that emerged was quite to be expected, and throughout the day we saw the bids emerging from importers, and oil companies were also seen in action. So the rupee went towards 87.20, although further gains in the rupee does look difficult, because we are already seeing RER correcting substantially, with a dollar index moving to 104, and the US economy showing weakness. There are chances of more rate cuts than just two, and that will also help the emerging market currencies, including India. Definitely, Indian sentiment will not get a big boost unless we see a turn in the FII flows, but that is not seen right now. Yesterday also we had seen an outflow of close to 200 million US dollar, and this trend has been continuing. And with the global markets, as we said earlier, the US markets continuing to fall and entering a correction territory, that can keep the Indian and the other emerging market also on the softer side, which will lead to FIs being not drawn into buying the stocks. So we may have to wait till the bearishness on the stock markets globally also recede, and then may see some pickup in the FI flow. Still then, USD INR is not likely to see much lower shade, except for the year-end flows that may emerge, and that can keep the lid on the upside. So I'm still seeing a range of 86.50 and 87.50 holding for this month. Of course, the job data, monthly jobs data from US today is going to be very crucial, despite all the indications that the job market is slowing with layoffs and government cuts on the expenditure. Forecast is for 1,60,000 increase, which is more than 1,42,000 that was seen last month, and the unemployment rate is expected to be at 4%. So I think this number holds a key for the next direction in the dollar. Thank
Thank you, JK. And just quickly highlighting one important thing you mentioned about the ECB. Now, the ECB cut rates yesterday by 25 basis points, but market were pricing earlier a clear rate cut path. But after this fiscal bazooka, which Germany and the EU region has sort of, it is moving toward, the EU itself is quite uncertain when it comes to its rate path. So, because we are also seeing sharp rise in bond yields of all these EU regions, especially Germany. And it's also being said that Europe will float a common bond for these upcoming large defense expenditure. All of this is in contrast to what's happening in the US, where the economy is considerably weakening and the US yields are also gradually falling. And if you put all these pieces of puzzle together, and from the Asian side, you have got the Japanese yields which are rising. You're seeing the good amount of yen strength as well. So a lot of different pieces coming together and moving the markets. We are seeing euro rise quite sharply. For rupee, though, we opened yesterday below 87 and quickly traded above that. But as JK mentioned, the 1 year premium fell sharply from 1.90 rupees to 1.70 rupees, 20 paisa fall. And as RBI had announced the buy sell swap, so the lower spot plus lower premium, it garnered a lot of importer demand. That's it from us today. Thanks for listening. Have a very good weekend, and we'll see you all on Monday with a fresh round of updates.